Welcome back to the channel. My name is Brad, and today we're going to talk about AIPI from Rex shares. I will also do a follow-up on FEPI with a little bit more information on how they did and some of their testing. So first of all, let's talk about the state of the cover call industry as a whole. I have received several messages about cover calls and they're not going to last and these funds will be going away. Well, what does the data actually say about these accusations? According to the chart, that doesn't seem to be true. Matter of fact, this is 80,000 million, which just happens to be a lot of money. So the market is growing at a significant pace, and retirees and other people are looking into these funds. I'm going to share a chart on what this actually means with a cover call and when do they outperform and when do they underperform. So they underperform when there's an up market, and this is when they sell a cover call and it hits its strike price. It will never perform as good as the market, and it will always lag the market because it hit the strike price. In a slightly up market, it's going to outperform and it's ideal. So if the market's only going up slightly over time, this is the best for the funds. If it's a sideways market, it will outperform. This means because of the cover call money being put in and you're receiving those distributions, and if you're reinvesting those distributions, you will outperform the market. In a downwards market, and this is what everybody gets wrong, in a downwards market, it's going to outperform because of the covered calls. You're going to receive the distributions, you're going to reinvest those distributions, and you will beat the market. This appears to not sink in to a lot of the comments that I read. Up market, we're going to underperform. Moderate up market is ideal. We're going to get it, and we're going to get the up market side. Sideways market, we should outperform because it's not going to hit our strike prices. In a downwards market, we will always outperform. So when everybody says, when there's a 60% correction, I do believe they call that a downward market. Correct me if I'm wrong. Please leave a comment below if I'm wrong on that a downward market would be a correction. AIPI is based on the BITA AI Leaders Select Index. So this is actually an index-based fund. So there's actually an index that they're following, and what they're not doing is writing calls against the index, but they hold the individual stocks of the index. Historically, this index has done better than the S&P 500 on a longer time frame. And these holdings are 25 individual stocks that make up this index. Many of you will already recognize a lot of these names. So the BITI AI Leaders Select Index is either Purity Leaders, which is a fixed portion of the portfolio is 40%, and Key Enablers, which allows the fixed proportion to be 60%. So Purity Leaders, meaning these are the ones that are dedicated to AI, is 40% of the index, and Key Enablers are 60% of the index. One thing that you should know, on a monthly basis, they will rebalance. On a quarterly basis, they will look and reconstitution. What does that actually mean? Reconstitution means if a stock gets dropped off the index, they will not drop it off immediately from the ETF. They will do that on a quarterly basis, and they will replace that stock when it becomes time to reconstitute. NAV appreciation. Everybody talks about NAV erosion. So how do they combat NAV erosion with NAV appreciation? Interesting conversation. This is they sell the calls approximately 5% out of the money. Their call rating is 5% out of the money every month. Now, they sell on monthly and not weekly. And they roll once we get to the monthly. If you don't know what I mean, stocks have options on weekly and they have monthly options. And Rex Shares is doing monthly options that they're rolling every month. One thing that needs to be a conversation that I don't think that everybody understands. Individual stocks have more volatility than indexes. So Brad, what are you saying? So on covered call ETFs, if they're selling on individual stocks and not an index, the implied volatility will be higher. That's why you see some of these other funds selling on individual stocks. So what does this actually look like? If we look at the 5-year average implied volatility, and if you look to the far right, you're going to see two indexes that may be QDTE and XTTE right on, and you'll see all the other individual stocks that AIPI happens to be writing on, which all have a higher implied volatility, which means they will make more option premiums for selling those calls. So how did AIPI do in my testing? When I did my testing, first of all, I noticed quickly AIPI outpaced SPY in the beginning. And then there was a slight correction and AIPI fell below SPY. Then we have some distributions come into play, and quickly you notice that it's catching back up to SPY. Unfortunately, it didn't hold its NAV, and unfortunately this is a newer stock. But it's interesting how quickly it regained on SPY. If I look at how much I'm reinvesting by scraping off my 8%, it's over $1,000 a month going back into this fund with a $50,000 investment. So one thing I did with AIPI is I took a 25% withdrawal and reinvested the rest. And when I look at that chart, I'm above my NAV and I can pull out 25%, not the 15 test that I normally do, but 25. When I look at FEPI, it has the same issue. At one time, it was above the S&P 500, and then it fell behind the S&P 500. And it's just a matter of time. When does the AI stocks become in favor again? The other one is Intel, that had a huge drop, but Intel is going to recover. It's just a matter of time. And with that, will they catch back up to SPY? With distributions being reinvested, yes, they probably will be. If you're scraping off the 8%, it's going to take longer. With FEPI, I went in and did my 25% test again. 25, not 15. And it did very well. It's not as good as I would hope, but it's still above NAV, pulling out 25%. That is a very healthy amount to pull out. So I scored these. And unfortunately, since they're new, they did okay, but they're coming up on that 1-year mark for FEPI, and AIPI is still a younger fund. They passed my 8%. They passed my 10%. They hold the underlyings. They do not beat the S&P 500 yet. ROC, that's a great conversation. According to the fund managers, last year FEPI was 100% income, not return of capital. I looked at the 19A-1s, and again, according to their fund manager, they're expecting it all to be ordinary income and not return of capital. That was an interesting comment that I heard from the fund manager. Unfortunately, at the time of this testing, it does not hold NAV without reinvestment. But if you look at those charts, it's very close, and it's only a matter of time. And if it wasn't for Intel, it would have. It passes holding NAV with 15% withdrawal. It's based on individual stocks. And unfortunately for AIPI, they don't have 200 million. But obviously you might have caught on that I said what the fund manager said. Because Brad got to sit in an institutional investor meeting with Rex shares. And it was interesting what these fund managers actually said. And it also made me look up some other information. Now, FEPI scores a little bit better. They almost have that NAV with the not reinvesting. And they're coming up on that 1 year worth of data. So in 3 or 4 months, this is probably going to score an 8 and not a 6. So let me finish up by closing with a little bit of information. FEPI, 200,000 shares is actually owned by institutional investors. And as I pointed out earlier, I got into an institutional investor meeting where they were pitching AIPI as well as FEPI, but more AIPI. That conversation is very interesting. I went out and looked. No institutional investors own XDTE or QDTE as of yet. Institutional holders own FEPI of 200,000 shares. The link will be in the pinned comment and in the description, so you can go look it up yourself of how many institutional investors are actually involved in these funds. Because if institutions are getting into these funds, you know that they're not going to be jumping out. You know it's a consistent share hold. And it really makes me have a better feeling about the funds when I see institutions getting involved in funds. In conclusion, I think this is a fair and balanced perspective of FEPI and AIPI. I will start investing in AIPI and buy shares, taking a little bit of revenue from other funds and investing it into AIPI to diversify my portfolio even farther than it is today. So until next time, God bless.